Hey, good morning, guys. Welcome to the Mortgage Rate Forecast. It is April 26th, and let's get started with some news. Interesting, earlier this week, the Shiller appreciation report came out for the housing markets, major metropolitan housing markets across the U.S. Los Angeles came in at a monthly appreciation rate of 1.1. 1.0. San Diego came in at 1.1. That's putting LA right now over the 12-month change right at 8.3% and San Diego at 7.6%. I'm going to put all the metropolitan cities linked down at the bottom of the description. So if you want to check out yours, see where the Shiller came in at, check it out. But we are seeing acceleration of appreciation since mid-2014. So appreciation just isn't going up at a steady rate. It's actually starting to go up faster. So I think this is just a notable thing. Obviously it's impacting bonds, which is what this channel is all about. But guess what? This channel is also about mortgage rates and trying to figure out the best time. And so anyway, this appreciation rate showing acceleration, it's a telltale sign that, housing is continuing to go up in price. So let's get to today's reports though. Really a lot of bad news for bonds, but wait till you see the charts. The charts are actually looking pretty darn good. I mean, initial jobless claims came out way below expectations. Durable goods were not bond friendly. And even today, if you look at the stock market, that's up 250 points. So why are we trading so well? It's based on the technicals. So let's get over to the charts. But here's what we have. A big part of this, guys, is the 10-year treasury is just under 3%. So traders are saying, hey man, there's a lot of good reports, but we don't want to pull our money out of bonds just yet. So here's what we have, guys. We're currently trading at 101.55. You can see we're still in this downward trading channel. We broke out of it, opened below it yesterday, but closed just right in the channel if you look at my mouse. And today we're right in the middle of this channel. So it was just a good relief for mortgage-backed securities today. We're not like getting too much worse, but here's where we're at. To kind of quantify, Freddie Mac reported a 4.4 rate at a half of a point back in March. That's when trading was about 102.50. We're at 101.55, which is about $1 worse than where we were last month. And Freddie reported the average consumer to get that rate was paying about a half a point. So this means the average consumer is probably paying, over a point and a half or pretty darn close to it for that same approximate 4.5 rate. So anyway, that's where we're at today, and the market, as you can see, just over the last couple of weeks has gotten worse. We got some footing, but it's just a mixed bag of news as far as the forecast. As far as my last forecast last Thursday, I was off by 1 cent. I estimated bonds would get as low as 56 cents. And guess what today? We're at 55 cents, 101.55. So sorry guys, but hey, I wasn't off by too much, not by too much. So what about this coming week? What do we see? Well, analysts on the short term it's just mixed. Some of them are saying bullish, like we're gonna go out there and we're gonna climb up and trade higher. Others are neutral, like I don't see any change. I think we're just gonna stay pretty flat. And other analysts are bearish. So, but the one thing they can all agree on, along with myself, is the long term is going to probably be bearish, meaning that bonds will continue to be pressured down. And again, sorry for saying that quantitative easing word. I know I'm beating a dead horse, but that is a major thing that's really pushing down bonds. So let's get to my next week's forecast. Here's what we have. We're currently trading at 101.55. I don't think through this next Thursday we're going to get above 101.80, but I also don't think we're going to go below 101.10. So that is my forecast. So to kind of quantify this for you, we could get better by about 35 cents, which equals about 3/8 of a point. But we could get worse by almost a half of a point. So I think again, guys, we have, if you do go short term, you might want to see what happens today, what happens with trading. We are having a nice day today, but if you're looking at locking in over the next week or so, just be really careful. I think we have more downward pressure than we have upward momentum. So anyway, that's it for this week. Hey, we'd like to hear from you. Leave those comments down below. Don't forget to hit that like button before you go. I have to say that. We've got to get some more likes on these videos. And if it's your first time on the site, go over to the top left, click that ugly guy. That'll get you subscribed. You'll just get a little notification when we release new content. And if none of this made sense to you, it's okay. It's kind of weird how bonds work. You can go to Mortgage Bonds 101. That's going to be a link at your top right. Boom. And that'll teach you the basics that you need to know when you're trying to figure out the best time to lock in your interest rate. Anyway, that's it for now. We'll see you next Thursday. Good luck out there. Bye-bye.